I wrote a memo called Fewer Losers or More Winners. You have to make a choice. And if you're going to try to win in investing, which means win in our business means having superior results, how can you possibly get superior results? And the answer is you either have more of the things that go up or less of the things that go down, or both. Most people can't do both because the skillful, aggressive player might be able to get more of the winners. The skillful defensive player might be able to have fewer of the losers. Very few people have enough equipment to do both. Most people, that means you have to choose.
Before we dive into the video, if you've been enjoying the show, be sure to click the subscribe button below so you never miss an episode. It's a free and easy way to support us, and we'd really appreciate it. Thank you so much.
Hi, folks. I'm absolutely thrilled to welcome back a very special guest today, Howard Marks, who's the chairman of Oaktree Capital Management. It's been a landmark year, both for Oaktree and Howard. Oaktree recently celebrated its 30-year anniversary, and since Howard co-founded the firm in 1995, it's been a spectacular success. It's grown into a globally revered leader in alternative investments with something like $218 billion in assets under management and more than 1,400 employees around the world. And a few weeks ago, Howard also celebrated another landmark, which is 35 years of writing his extraordinary memos, which are such a trove of clear and lucid investment wisdom that they've earned a devoted following of, I think, more than 300,000 subscribers. Howard marked that anniversary by publishing a free compilation of 45 of the best memos, which I spent the last couple of days rereading. I would say personally that nobody other than Warren Buffett has done more to distill and share the enduring truths of investing. So today we're going to focus in some depth on some of the most important things that Howard's figured out in his 56 years, not only as one of the great investors of our time, but I would say also one of the great teachers of the investing world. So Howard, it's lovely to see you again. Thank you so much for joining us.
Thank you, William. With a introduction like that, I'm tempted to say go on.
Okay, well, we're off to a good start then. I wanted to start by asking you about a really important dinner that you had in Minneapolis in 1990 that had a profound impact on you, both in terms of inspiring your first memo, but also, I think, subsequently in shaping Oaktree's investment philosophy. Why was that dinner such a seminal event, and what did you learn from it?
Well, I had dinner with a guy named David Van Benschoten, who ran the pension fund for General Mills. And he was a good friend and a good client. And he told me that he'd been running the plan for 14 years. And in the 14 years, their equity portfolio had never been above the 27th percentile of pension fund equity portfolios or below the 47th. So solidly in the second quarter for 14 years in a row. But interestingly, as a result, for the 14 years overall, they were in the 4th percentile. Now, that's incredible math. You would say, well, if you bounce back and forth between 27 and 47, on average, you're probably about 37. No, 4th. How could that be? And the answer turns out to be that most investors shoot for the stars and occasionally shoot themselves in the foot and wreck their record. And once you have a big loss, it takes a long time to get back to scratch. So I thought that was really important. So I wrote the first memo called The Route to Performance. As you say, it had a great impact on us. And I knew you were going to ask this question, so I went back and looked at the first memo. And it happens to say in there, simply put, what the pension fund's record tells me is that in equities, if you can avoid the losers and losing years, the winners will take care of themselves. And when we started Oaktree in 1995, I wrote that down, and that became our motto, and still is. If you can avoid the losers, the winners will take care of themselves. I think that's an